Hello and welcome to our daily Forex market analysis. My name is Schimming, and this review is for Friday, March the 8th, covering the U.S. non-farm employment session. Now, for those who are active in the financial markets, you should be well aware of the fact that the U.S. non-farm employment change and unemployment rate numbers came out better than expected. Now, this comes off the heels of the ADP non-farm employment change numbers released on Wednesday, which were estimated to be at 172,000 but came out at 198,000. We also, with the ADP numbers, saw the previous report revised from 192K up to 215K. Now, this was the caveat or influence for some analysts to raise their estimates for the non-farm employment change numbers that were due out on Friday. We saw, as according to the Bloomberg survey, which I believe is the largest survey of its kind, all analysts surveyed on a median estimate was in the 165,000 range. However, that report came out at 236,000, and if you recall from yesterday's video on the 7th, we discussed how a report of 200,000 or greater would not only be a surprise to the market, but an extreme positive, and that's exactly what we saw. Now, my concern is the fact that the previous month we saw that number revised down from 157,000 all the way down to 119. That's a pretty substantial revision, but the market seemed to want to ignore that, or at least ignore that number for now. I believe that was overshadowed by the fact that the unemployment rate, which was previously at 7.9% and forecasted to remain at 7.9%, was shown to adjust down to 7.7%. I think this also was a surprise to the market and considered a fundamental positive to the U.S. dollar and U.S. equity markets. Now, I think largely, in fact, this is probably due to people dropping out of the unemployment ranks altogether, but a positive report all the same. So let's see the effect on the marketplace. We'll start here in the top left-hand corner and looking at my currency strength chart. And as you know, this is identifying or isolating each individual currency so you can see their strength and or weakness in the marketplace. We're looking and drawing this from the world's largest global liquidity pool and looking at every transaction done electronically in that pool. We also trade into that pool, and we have direct ECN access to trade against and inside that marketplace. Now, going into the report, you can see how the dollar, really all the currencies were moving fairly sideways, except the yen, which is trading down. Now, I'm going to take out the New Zealand, and I'm going to remove the CAD. And I think that I just want to take it down to 6 instead of the 8. Just to clean up the chart a little bit and so we can have a greater focus on the major currencies that were in play for the session. You can see from the report forward that the dollar did gain quite a bit of lift and started trending upward for several hours. It was a nice move to the dollar, a fundamentally correct move, and one that was well received by traders. So from previous lessons, you know that our desire as a currency trader is to look at this chart and decide and identify what currencies are moving up, what currencies are moving down, and which currencies aren't trending at all. As a spot currency trader, you're looking to put yourself in a situation where both currencies of the pair are moving in the desired direction of your trade, meaning one needs to be moving up and one needs to be moving down. Now, knowing one is going to carry the bulk of the trade, but what I'm trying to avoid is where one currency is trading against me. So in this case, with the dollar trending higher here in green, we're going to look for what currencies are trending lower. The Aussie is still moving up, and the yen was moving up with the dollar, and that's a positive situation. But what's trending lower is the pound here in pink, the euro displayed in red, and the Swiss, because it's pegged to the euro, also trading to the downside. So the ideal trades during the non-farm payroll session would have been short trades in the euro dollar or pound dollar and long trades in the dollar Swiss. Now let's look at the dollar a little bit differently. We'll go to our modified dollar index. Now the modified dollar index is another tool that we've created to give you an excellent advantage against the market and other traders. This is a real advantage to you because when you look at the dollar index, it was implemented in March of 1973. Now, the world's economy is just much different than it was in '73, and the weightings of a standardized dollar index is just not as pertinent in today's world economy. Because of this fact, we've taken a modern approach to how the index should be calculated, and we've adjusted the weightings to reflect the current monetary flows. We've also made it more sensitive to currency price movements that are experienced today. So our modified dollar index can be used to get a much better feel of the dollar's strength and or weakness compared to the other currencies that it's weighted against, and this provides or can provide a clear benefit to you as a trader. Now, looking at the modified dollar index, we can see from late in Thursday it already started to move to the upside. Again, this might have been somewhat of a bias because of the ADP numbers, but traders had let the dollar trade down and now are lifting it back up. But I want you to look right here in the center of the chart when the release came out. There was a momentary movement of the dollar to the downside, really came into this support level that was established just a few hours earlier. And then we see the release and we see it shoot to the upside. You see a couple pullbacks, and each pullback sets a significant higher low, and the dollar index continues to trade higher, or I should say the dollar against the other currencies continues to trade higher. Similar to what we saw on the CCYX. Dollar strength, pound and euro and Swiss weakness against it. So this does in fact create a great opportunity for us, and by looking at the modified dollar index we get a better handle, or what I should say a more confident view in looking at the marketplace. Now let's take this one step further. Let's look at the pound dollar. The two trades, the primary trades that were made in our trade room were short in the pound dollar and short in the euro dollar. So let's just look at both of them real quickly. The initial release right here where you see, now this is looking at pure price, range bar charting technology. I introduced range bar charting to the Forex industry, and our software product is, and our team, we are the clear leaders in the field of providing pure price technology. So you can see that the initial release, there is a very sharp drop. Now I got to tell you, this movement here is probably too quick and happened too fast for you really to take advantage of it. And I'll show you and explain that a little bit further in a moment. What we looked at is the opportunity. We allow the initial knee-jerk reaction to come through the market, then we look for it to what the real market is going to do. We want it to disseminate into the marketplace and see what the real trend is. Again, we're definitely, because of the number of not only the jobs creation number but the unemployment rate number, we're really looking fundamentally for the dollar to maintain some strength. We saw that in the dollar index. I showed you that it had pulled back and kept lifting higher, pull back again and lift higher still. Well, look at what happened in the pound dollar. We get this initial very sharp move down, but it moved higher, came into our integrated average range and traded lower. This was the shorting opportunity. After the report came out, your shorting opportunity was as it broke S1 and traded down to the S3 range, or S2 range. This was a great opportunity. I don't know, in my opinion, I don't think the pound was the best situation overall because it had shown more strength prior to the report, but it still was actually the faster trade and still reduced and produced some good pip results for traders who took it. Now let's look at the other trade. Now the euro dollar to the downside I'm a little more familiar with because this is the trade that I placed. And it's a very similar situation where you see the initial movement down, but then we get the move up that set the lower high, and this becomes pretty significant. And let me just take a moment just to circle this area because I want to identify what's really happening here. Not only do we get the initial movement to the downside, but this retracement up that set a lower high accomplishes a couple of things. Not only does it set a lower high and give us an opportunity in, again, knowing that this movement down here was instantaneous and would have been very difficult to catch. I realize that my charts disassemble this and make a rapid price move very clear, so you think that you could have taken this trade, but unless you were positioned before the report taking a very gambling approach to the marketplace, largely in fact this was not a tradable situation. As it moved up, however, setting that lower high, testing my D-line range and the integrated average range, and even more significantly for the broad market, it came up and tested the pivot point. You can see that very tall wick. Wicks and tails are greatly reduced on our charting mechanism, and because of that, the significance when they do display becomes much more relevant to us as a trader. But if you look at that wick right there, you see that it traded as a high of 30.60. And you see that the pivot point was at 30 3063. So this is a test of the pivot. It's a test of my D-line configuration. It's a test of our integrated average configuration, and it's a lower high. This is significant opportunity. As it started trading down, this is where I took the short trade on the euro-dollar pair. As a matter of fact, it's not like I got it at 60. I'm not going to sit here and tell you that I short at the highs and buy at the lows. That's impossible. Traders that tell you they're doing that are lying to you. My trade was instigated at 1.3038. At 30.38 is where I shorted the pair. Now, initially it came down to S1, sat here for a while, and you can see that these low marks actually were a great opportunity, and we get some pretty decent movements to the downside. And I did cover and close 40% of this trade, or about half of this trade, eliminating the risk, capturing a gain, and moving my stop into a break-even or a profitable situation in this case. So this is a risk elimination strategy that we employ on almost every trade we take. As the dollar, and we saw that dollar pull back and lifting higher, we also saw the dollar continue up. The euro continued with its weakness to the downside. Recall what the CCYX show continued and pretty consistent euro weakness, and ultimately the pair came down to 29, let's see, what's the low here, 29.63. We had some lower points in that, 56 and 55. Craig, one of the moderators and traders in our room, I'll give him credit again today because he's the one that pointed out to the room, said, hey, that's 60, that 64, 60 range. If you go back a few weeks, you'll see that the pair has been down there a couple of times and has provided pretty decent support. So because of his comment and alerting us and reminding us of this fact, I covered the balance of that trade at 67, so that gave a 71 pip gain on the second half of the trade. A great trade considering, and I think taking great advantage of the support that was available and the movement that was afforded us in the time frame in which we traded the pair. You can see throughout the day, on the balance of the day, it came back down to this level, 59 here, and came down to 57. Again, I didn't get the ultimate low, close that trade at 67, but capture the lion's share of the movement here, and that's as good of opportunity as I think, or good of a result as a trader could take from this. And I'm very happy with the trade, and I know traders in the room that shorted euro dollar and shorted the pound dollar are very happy with the results. Not bad for a couple of hours of work. Now let's look at this one other way, and I want to show you, and you're looking at my charts thinking these charts are much different than what I'm looking at. So you look at euro dollar here on the top left and euro dollar on the bottom left, and we have pound dollar on the top right and pound dollar on the bottom right. The difference is I have a 12 pip chart on the top of both the euro dollar and the pound dollar. I have a 10-minute chart on the bottom of both the euro dollar and the pound dollar. And this is why I tell you that initial movement, look on your time-based chart, all that initial movement happened in less than 10 minutes. Not something that you could really gravitate towards. And looking at it moving up and setting that slightly lower high is absolutely gone on this euro dollar chart. The trade we took was when it came down to this level, moved back up inside of this bar, and then traded lower. On the euro dollar, the entire trade that we took was inside of this candle. So those of you who are time-based traders are missing the best opportunities in the marketplace, the clarity and the significance of seeing the disassembling of a rapid price move so that it becomes more legible, identifiable, and tradable. Same thing happens in a slower price market. It reassembles it and again makes it more legible, identifiable, and tradable. This is very difficult and almost worthless and gives you as a time-based trader really no advantage or no opportunity to take advantage of extreme price movements in the marketplace. Some of you don't even trade non-farm payroll because of this fact. When you look at the clarity difference of what we saw using my range bars and seeing that lower high inside of that elongated bar and the opportunity to grab 71 pips to the downside after the release had come out, it's a significant difference and an opportunity that should be intriguing and hopefully something that you would like to take advantage of. And you can. All you have to do is send an email to us. Send it to info@fxrbc.com. And we'll give you an opportunity to come onto our trade floor. We're getting ready to schedule a guest 2-week guest session, and you can get registered and attend with some other guests and be on our trade room for a couple of weeks. Experience this type of analysis firsthand, live, and while the markets are flowing. have the opportunity to trade with us under live market conditions, work with me as a trader, and allow me to show you how we approach the market and our simplistic strategies that are proven and yielding positive PIP results day after day and week after week. It's not to say that every trade we make is positive. That's just not the case. But overwhelmingly they are. And you can become a better trader. In some cases you just need better tools and a little bit better mentorship and education along the way. And my firm and myself are willing to offer you that opportunity. I strongly urge you and cordially invite you to join us, and I just don't think that you can find a better, more complete solution than what Forex Range Bar Charts is offering you today. So send us an email, info@fxrbc.com. And as always, if you have some questions, you want to post them on the video, hit subscribe so we can send you some updates through the YouTube video system. And we look forward to seeing you on our trade floor, answering your questions, and hopefully seeing you in our guest sessions. Again, my name is Derek Schimming with ForexRangeBarCharts.com. I want you guys and gals to have a great day trading. I'll see you on the floor.